Welcome back, students and scholars. In this episode, we are going to build a complete statement of cash flows under ASC 230 using a practical original case. Our company is Riverstone Components, a fictional manufacturing company created only for teaching. We will use the direct method to build operating cash flows, then use the indirect method as an independent proof, and finally assemble the complete statement. This is where cash flow preparation becomes real. Earlier videos gave us the map, today we are driving on the road. And in cash flow accounting, the road is simple. Follow the cash and do not let non-cash items sneak into the body wearing a cash flow costume. Here is the learning path. First, we read the beginning and ending cash balances to establish the control total. Second, we organize the case facts, including income statement items, working capital movements, and additional transactions. Third, we build the direct method operating section by converting accrual items into gross cash receipts and payments. Fourth, we classify investing and financing activities and remove non-cash items from the statement body. Fifth, we perform a final audit to prove that the full statement reconciles to the required cash change. The sequence matters. A professional preparer does not start randomly from formulas. First, we log the target, then we build, then we prove. Let us set up the case. Riverstone Components Inc. has total sales of $150,000, net income of $20,000, beginning cash of $18,000, and ending cash of $43,000. These four numbers frame the entire preparation exercise. Sales are accrual basis revenue, so they are not automatically equal to cash collected. Net income is the starting point for the indirect method proof. Beginning cash and ending cash give us the control total. These facts may look simple, but they are powerful. If we respect them from the start, the final statement has a much better chance of behaving itself. Before preparing any section, we calculate the cash change. Ending cash is $43,000. Beginning cash is $18,000. The net increase in cash is therefore $25,000. This $25,000 is the control total. The completed statement must explain exactly this amount through operating, investing, and financing cash flows. If the final statement does not reconcile to this number, there is a classification or calculation error somewhere. Do not force the answer by adjusting a random line. That is not accounting. That is spreadsheet astrology. The cash change is our anchor, and every section must tie back to it. Now we read the income statement clues. Sales of $150,000 will be converted into cash collected from customers. Cost of goods sold of $82,000 will be converted into cash paid to suppliers. Operating expenses of $28,000 will be converted using prepaid expense movement. Interest expense of $3,500 and tax expense of $6,500 are cash-related items in this case. Then we have depreciation of $12,000 and amortization of $2,000, both non-cash charges. We also have a gain on equipment sale of $4,000, which must be removed from operating cash flow because the actual cash proceeds are reported in investing activities. Working capital changes reveal the timing difference between accrual accounting and cash movement. Accounts receivable decreased from $22,000 to $18,000. So Riverstone collected $4,000 more cash than current period sales. Inventory increased from $25,000 to $31,000, meaning the company bought more inventory than it sold, increasing supplier cash payments. Accounts payable decreased from $17,000 to $14,000, meaning Riverstone paid off more supplier obligations, again increasing cash paid. Prepaid expenses decreased from $9,000 to $6,500, meaning the company used earlier prepayments and paid less cash than the current period expense amount. Working capital is not just balance sheet decoration, it tells the timing story of cash. Now we bring in the additional transaction facts. Riverstone sold equipment for $10,000, purchased equipment for $30,000, and sold an investment security for $7,500. These are investing activity transactions because they relate to long-term assets and investments. On the financing side, Riverstone issued common shares for $20,000, borrowed $15,000, had a draft debt repayment figure of $25,000 that needs audit review, and paid cash dividends of $12,000. The word draft is important. We are not accepting that debt repayment figure blindly. Cash flow preparation rewards careful reading and it punishes looks fine to me accounting very quickly. Now we separate non-cash facts. Riverstone recognized a finance lease asset of $12,000 with no cash paid at inception, and it also converted a $12,000 note payable into common shares. Both are real economic events and both affect the balance sheet. But neither belongs inside the statement of cash flows body because no cash changed hands. Under ASC 230, significant non-cash investing and financing activities are disclosed separately in a supplemental schedule or in the notes. This is one of the most important discipline points in the whole standard. Non-cash does not mean unimportant. It means important enough to disclose but not allowed inside the cash movement totals. Now let us calculate cash collected from customers under the direct method. We start with sales revenue of $150,000. Then we add beginning accounts receivable of $22,000 because some cash collected this period came from prior period sales. Then we subtract ending accounts receivable of $18,000 because those amounts have not yet been collected in cash. The result is $154,000. Another way to read the same result is that accounts receivable decreased by $4,000. So cash collected is $4,000 higher than sales. That is the direct method doing its job, converting accrual revenue into actual cash receipts. Now we calculate cash paid to suppliers. Start with cost of goods sold of $82,000. Add ending inventory of $31,000 because inventory on hand at period end was purchased but not yet expensed through COGS. Subtract beginning inventory of $25,000 because that inventory was already on hand at the start. Add beginning accounts payable of $17,000 because old supplier balances may have been paid in cash during the period. Subtract ending accounts payable of $14,000 because those balances are not yet paid in cash. The result is $91,000 paid to suppliers. This is why cash paid to suppliers is not simply COGS. COGS is the expense story, supplier cash paid is the cash story. Next, we complete the other operating cash payments. Operating expenses were $28,000. But prepaid expenses decreased from $9,000 to $6,500. Because prepaids decreased, the company used previously paid for benefits and paid less cash than the accrual expense amount. So operating expenses paid are $25,500. Interest paid is $3,500 in this case, and income taxes paid are $6,500. Together, other operating payments equal $35,500. This slide is a good reminder that the direct method is not just listing numbers from the income statement. It converts income statement amounts into cash amounts. Now we assemble the direct method operating section. Cash collected from customers is $154,000. Cash paid to suppliers is $91,000. Other operating payments are $35,500, so net cash provided by operating activities or CFO is $27,500. This is the operating result under the direct method. Notice how clear this presentation is for users. It shows cash collected, cash paid, and net operating cash flow. No need to unpack net income first. The direct method says, here is the cash engine. See what came in, see what went out, and see what stayed. Now we classify investing activities. Riverstone received $10,000 from the equipment sale. It also received $7,500 from selling an investment security. It paid $30,000 to purchase equipment. So net cash used in investing activities is $12,500. Notice that the full $10,000 of equipment sale proceeds is reported here, not just the $4,000 gain. The gain is an income statement effect and will be removed in the indirect reconciliation. Cash proceeds go to investing. Gain or loss adjustment goes to operating reconciliation. If we mix those two ideas, the statement may double count. And double counting is one of those accounting mistakes that quietly waits until review time to embarrass everyone. Now we prepare the first draft of financing activities. Riverstone received $20,000 from issuing shares and $15,000 from borrowing. It also shows a draft debt repayment of $25,000 and dividends paid of $12,000. This produces draft net cash from financing activities of -$2,000. But the slide correctly warns us that this is not the final number. The draft debt repayment includes a non-cash component. At this stage, we are intentionally showing the first draft so that we can perform an audit check. In real work, first drafts are allowed. Final drafts must reconcile. Now we assemble the first version of the statement. Operating cash flow is $27,500. Investing cash flow is -$12,500. Draft financing cash flow is -$2,000. The total is $13,000. But our required cash increase from the beginning was $25,000. That creates a $12,000 gap. This is exactly why the control total matters. The statement is telling us politely but firmly something is wrong. When this happens, the correct response is not to adjust cash magically. The correct response is to trace the transactions and find the classification error. Here is the audit adjustment. The statement must explain a net cash increase of $25,000, but the first assembly explains only $13,000. The $12,000 gap matches the note payable converted into common shares. That conversion was incorrectly included inside the draft $25,000 debt repayment figure. But a note conversion does not involve cash payment. Debt was settled by issuing equity, not by spending cash. Therefore, the $12,000 non-cash note conversion must be removed from the financing section and disclosed separately. The finance lease asset is also a non-cash item disclosed separately. This is the professional lesson. When the statement does not reconcile, do not guess. Follow the facts back to actual cash movement. Now we correct the financing section. Shares issued remain a $20,000 financing inflow. Debt borrowed remains a $15,000 financing inflow. Dividends paid remain a $12,000 financing outflow. The draft debt repayment of $25,000 is corrected by removing the $12,000 non-cash note conversion, leaving $13,000 of actual cash debt repayment. Now the corrected net cash from financing activities is $10,000. This correction changes financing cash flow from -$2,000 to +$10,000. That is not a small formatting issue. That is the difference between reporting cash transactions and accidentally reporting a non-cash balance sheet movement as if it were cash. Now the corrected final statement reconciles. Operating cash flow is $27,500. Investing cash flow is -$12,500. Financing cash flow is +$10,000. Together they equal a net cash increase of $25,000. Add that to beginning cash of $18,000 and we reach ending cash of $43,000. The statement now agrees with the balance sheet. This is the moment a preparer wants. The cash bridge is complete, the sections reconcile, and the control total has been hit exactly. When the statement ties cleanly, you can breathe. When it does not, the cash flow statement keeps staring at you like an unfinished reconciliation when the clock shows 11:50 at midnight. Now we prove operating cash flow using the indirect method. Start with net income of $20,000 Add back depreciation of $12,000 and amortization of $2,000 because both are non-cash expenses. Subtract the gain on equipment sale of $4,000 because the full proceeds are already reported in investing activities. Then apply the working capital net adjustment of -$2,500. Accounts receivable decrease adds $4,000, inventory increase deducts $6,000, accounts payable decrease deducts $3,000, prepaid expenses decrease adds $2,500. The net working capital adjustment is -$2,500. The result is $27,500, matching the direct method CFO. The proof is confirmed. Let us close with the 4 key takeaways. First, always control the cash change before preparing the statement. Beginning cash to ending cash is the anchor. Second, separate non-cash investing and financing activities into supplemental disclosure. They never belong inside the statement body. Third, classify every transaction carefully by tracing it back to the source facts. A single non-cash note conversion placed inside cash debt repayment can break the whole statement. Fourth, prove the result with reconciliation. If the direct method CFO and indirect method CFO agree and the 3 sections reconcile to the cash change, the statement is ready for disclosure. If this practical episode helped you, please like it, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can continue building serious free education. In the next video, we will move into special issues and disclosure traps under ASC 230, including classification edge cases, interest and tax policy elections, and supplemental disclosure requirements.